Hello, ladies and gentlemen. Well, this week the risk on-off model improved again. The closing score for the week was -33. If we have a look at the weekly model where the end of week scores are, we can see that it started the year on the first Friday on the 4th at -84, improved to -76, improved to -43, and finally it closed on Friday at -33. That's a significant improvement over the course of 3 trading weeks. 50 points, quite a lot. It is now through the first moving average and will start turning it soon. So what we have to understand is why it's doing what it's doing. The spreads are improving with price, and even though last week actually we closed lower on the week in terms of price, the model still went from -43 last Friday to -33 this Friday. So it improved despite a small correction in price, about 10-13 points in the S&Ps. So now what we have to do is go and review all the charts of the risk and the risk off, the bonds and the equities, and see what is changing and what actually could be the driver for the next few months. And I believe the driver is actually a shift of volatility from the assets themselves, which are bonds and equities, to the common denominator, which is the US dollar. As always, when there are fundamental things going on, it's good to first of all review where we are in terms of forward earnings. We're not really changing the forward earnings very much. Where we closed is actually right in between the times 15 and the times 16, so we're not particularly cheap and we're not particularly expensive. The times 16, I guess, is around the 27.25 level. That is going to be a 27.25, 27.50 is going to be extremely important on the upside. And I don't see it closing above there without some really fundamental news over the course of next week. So we know where our upside, unless we get amazing data, is located. But let's have a look at what the drivers are, and let's have a look at the joker in the pack, which is the US dollar. If we start looking at the belly of the curve, the 5 years and the yield, we can see that there wasn't really very much change over the course of the last week. 1 or 2 basis points. The 200-day moving average is completely flat. We've had the 50-day cross it. We have the Bollinger Bands at the top of the level that we think is so important, and that is 268. 267, 268 is going to be a very important level on the upside, and I do not expect it to be broken next week, even though we do have some very interesting data. 267, 268 should prove very much a level that we can take some trading action on, and that will naturally be tweeted through the course of next week. In terms of 10-year yields, we are looking still around this 286 area, which is so important. We just don't think that 285, 286 is going to be broken very easily. It is actually beyond the Bollinger Bands, so we might not get anywhere near there. But what is actually very interesting is if we look at the spread between the 10-year in Germany and the 10-year in the US, it is now coming back to test this very important minus 258, 259 basis points, which held for weeks and weeks and weeks, as you can see, and then finally we broke through. Well, what you would expect is with the ECB being as easy as it is, you would expect this spread to actually have come in slightly last week, but it didn't. It went out. And with that spread going out, that to me indicates that the dollar should have been stronger, and it wasn't. When the market does things which counter to all expectations and counter to all previous trading assumptions and realizations, there is something fundamental going on. The market is talking to you and it's saying that it's unhappy about something and that something is rotating in a big way. So that is what we really need to have a look at. But it's important that you realize that when the market has done what it has done over the course of the past week, and actually spreads went out something like 6-7 basis points, you would have expected the dollar to be bid, and it wasn't. On Friday, the dollar went for a complete Burton, and we have to examine why that was and whether it's purely technical or it's becoming fundamental and signaling that something big is afoot in foreign exchange. So here we have the daily chart of DXY with all the levels that have been in there for weeks and months and years. And 96.50, we tried to break it. We tried to break it on Friday. I fully expected us to go and at least and test the 96.70, 80 level, but no, we did a abrupt volte-face, and we closed the week at the lowest levels of the week and lower than the previous week, even though the yield spreads, as I've just shown you, went out, and you would have expected those to have been supportive of the dollar, and the dollar having traded up here towards 96.80 level through the 96.50 level, which is so important. If we try and zoom in some more, we will see basically that now we are coming in to the lower Bollinger Band and to the into the 200-day moving average of the DXY, which is located very much at this level, which was 95.07, which we touched a few times a couple of weeks ago and bounced off it and went higher. Well, we are in big danger now of actually breaking 95.07. If we do break 95.07 and have a couple of closes below there, that will mean that we have broken the 200-day sloping moving average, sloping upwards, and without a reason. And when markets do things without a reason or contrary to the reasons which exist in the market, because don't forget the DXY has actually mirrored the spread between the 10-year notes in the States and the 10-year bonds very well, and has moved with the spread. Friday was the first day that he moved against the spread and actually gave sell signals in a lot of indicators, or is very close to giving sell signals in a lot of indicators. I firmly now believe that if 95.07 gives way, 93.63 is very close by, and that will actually be below the this trend line which has been catching it, this parallel which has been catching it for such a long time. If we now start breaking down below, first of all 95.07 and then 93.63, there will be a move at best, I reckon, all the way to this trend line, which was where the lows of the year were in 2018, and basically way below 90, closer to 89. Now that is a big move in the dollar, and we have to examine why that would be and what the result of it will be on the pricing of assets denominated in US dollars. Well, here we have a chart of emerging markets over the SPY. You can see how much the SPY has outperformed the emerging markets over the past decade, let's say. It has really gone from 40 to 15. So tripled it. It has tripled the performance of the emerging markets. For the first time, and if we enlarge this sector here, you can actually see a bit better. For the first time, we have now closed above the 200-day moving average, which is still down sloping, and we have the 50-day coming up, and we have the 20-day coming up, and it's looking to take out this previous high, which happened in the beginning part of in the latter part of December. This is the big rally in SPY from the lows, and the spread actually is going there again. That is basically saying that SPY effectively against EEM will still be trading in the 2350s in a few days time when we get up there. That to me indicates dollar weakness, because I don't believe that EEM would be rallying on a relative basis to SPY without an anticipation by emerging markets that dollar liquidity will be plentiful and that the price of US dollars will actually go down. What is interesting is that this spread bottomed out in October, just as the SPY was turning over and keeling over, and you can see how much it's improved. So we are really at an inflection point. Either we go back down or we go back through and go probably a lot higher. This could be some sort of inverted head and shoulders, but you know, I'm not going to go there. I want to see this high here taken out, and don't forget these levels have been here forever. So if we go through this point 16353, and I will naturally alert you of it, we have a lot of room to go higher, and that will be presaging a lot of dollar weakness for whatever reason. This is a monthly chart of the S&Ps, and if we enlarge what the price action is telling us, you can see that it's testing this very important line. We're coming up towards month end, 26 basically 80, 77.80, that's the level. If we close above there, we're definitely going to go to this line, which is 27.35, call it 27.25. It is telling us that we are at very important levels on the monthlies as well as the other charts, which we will look at in the moment. It is telling us that we are flirting with breaking this downtrend, which has lasted since October. If we do that, we will have a very powerful risk on, which will be exacerbated, if you think about it, by the cheapness of the dollar. If the dollar now starts going down percentage points, you know, we've been talking about a move which is roughly 10% from here. If we go to 89 from where we are, okay, it's 7-8%, which is in FX a huge move, and that could easily push us through these levels and higher towards all-time highs. Let's see if the other time frames support that assumption. This is an enlarged chart of the weekly, and as if by magic, we have the same levels really on the weeklies. Basically 26.77.80, you break that, we go to 27.30. Above 27.30 we actually have air all the way up to 28.26. Nothing above 27.30. That's why I think that 27.25 level is going to be so important, because A, it's the 0.618 retracement of this whole move, and B, because if we were to bust it, I mean, basically we are looking for new all-time highs, which to me is amazing given that what the shape of the economy is, And all I can think of is that there is some agreement in the air about cheapening the dollar and therefore making US assets even more attractive. I don't know whether I'm just speculating aloud. I have absolutely no idea why that should be, but the market, I will repeat, when the market does something completely on its own and breaks with a pattern that it has been in for weeks and months and even years. I mean, the US dollar has been as regular as clockwork in following the spread between 10-year notes and bonds. You know that something is afoot. And when you see that the monthlies and the weeklies also align technically, and maybe we're about to give a buy signal here, well, that indicates to me that the upside is the one that you should fear much more than the downside. On a daily basis, as if by magic, we are opening up the Bollinger Bands and going back up towards 27.25. 27.25 is actually the 1.618 as well of this ABC. First of all, we have the 1.38, 2684, so basically we've touched it. If we go through 77, I have no doubt within 3 or 4 days we're at 27.25 and basically touching the 200-day moving average, which is just above it at 27.41. So this battle between risk on and risk off is raging, and I keep on asking myself now, what is going to tip the balance in favor of the risk on fighters? Well, to me, the only thing which could do that is a significant cheapening of the dollar. You cheapen the dollar by 6, 7, 8%, and then that effectively breathes new life into the S&Ps, simply because the asset becomes cheaper per se. I know some people will start arguing that it indicates outflow out of dollars. No, I don't think that's the case. I think it indicates a looser policy by the Fed, something which either steepens the yield curve enormously, or a new round of QE, or something that we just cannot see on the horizon, but the market as a whole is beginning to see, and is beginning to see a danger of significantly weaker US dollar, which actually supports equity asset prices. In the shorter time frame, it's absolutely amazing how even the rollovers in the market over the course of the last week have really not weakened the trend of this longer moving average at all. Very slightly in the shorter term moving averages, but nothing really in the longer term. It's still marching on, and it's not turning over. I expected it to start turning over when we did this. It didn't. The market went straight higher. Even when we had bad earnings, it just kept on going, and prices just could not stay down. That to me indicates buying underneath. Every time there's a dip, people come in and buy, people come in and buy. And if that's the case, I would expect this 77 level at some stage to be broken decisively, and we break 77, we are very rapidly en route to 27.25. The weekly volatility chart is also very interesting. If we enlarge it, we have this very important level here as 1608. 1608 is actually a trigger on the risk on, risk off model, and we have some moving averages actually turning down. The 200 week is flat, the 50 week is actually trending down. Every time we've gone up over the past few weeks, we've just been slammed and closed right at the lows of the week. I mean, look at these bars: at the low of the week, at the low of the week, at the low of the week, just about at the low of the week, at the low of the week. To me, this is an indication And if you have a look at where we were here when we're trading at these levels at 1610, we were actually at 2800 in the S&Ps. So that to me indicates something that could happen next week is that we test 1608. Probably the first once or twice we bounce off it quite hard, but eventually if this maintains this pattern, we will be coming back down below it and into the 14s very rapidly. That to me is a pattern which indicates a strong upside potential in equity prices, and again, I cannot think that it has anything else to do but with the potential for a real strong move in the dollar. If the dollar is going to have a significant move, you would have thought that gold and commodities would also respond. Well, this is a daily chart of gold, and as you can see, we have this tightening of the Bollinger Bands, and we closed Friday right at the highs of the year. And this certainly indicates, because the 50-day moving average is about to cross the 200, a bit of hesitation here, and then the next leg higher, probably all the way to 1380, or even to up to 1400. That to me indicates a market which is getting ready for a significant dollar, weakness. And you would have thought that with the dollar where it was, gold would actually be trading down here around 1250. Well, it's not. We have to ask ourselves, why isn't it trading at 1250? Why is it trading significantly higher? If we have a look at commodities on a daily chart, we can actually see that they reversed together with the S&Ps and are now breaking higher. They can go significantly higher, probably all the way to this level here around 1667. That would indicate potentially oil strength, which would come in through dollar weakness, a whole load of things which are coincidental with dollar weakness. There are just too many indicators out there which are pointing to the potential for dollar weakness for us to be able to ignore it. The market has done, for a start, the market has done something completely unexpected on Friday. It has broken a pattern in which it has been for weeks and months of following the spread between the 10-year note and the Bund, and the coincidental indicators like gold, like oil, like DBC are all pointing to higher prices. The EEM spread is pointing to higher prices, and that to me is an indicator that the market is getting ready for significant dollar weakness. I've left the weekly chart of the euro till last, simply because it is the coup de grace of the argument, as it were. So here we have what the euro has been doing for since basically 2010, and if we enlarge this last part of the trading action, the surprising thing is that on Friday we weren't that far away from the bottom of the weekly Bollinger Band. So that is why I thought, well, no problem, the dollar's gonna strengthen, the euro's gonna weaken until 112.20 or something over the course of the next few days. It turned around and basically closed higher for the week. This very long-term moving average is now turning, and the market just cannot close below it. You can see how many times it's tried to close below it, and it's never ever achieved it. That to me says that we could actually have a move towards this kind of level, 116.50, 60, without any problem in the next 2 or 3 weeks. That would be very, very interesting, because if we do that, we will definitely see a move in the DXY below that 93 very important level, 93.50, whatever it is. That will really put the cat among the pigeon, because it is inconceivable to me that we don't get some considerable risk on in US equities if we have a significant dollar weakness. So on to the biases for next week. I still haven't changed the level in 10 years. It is all important. And to me, it becomes inconceivable that we could see a lot of further increases in US interest rates if we're going to get a down move in the US dollar. That becomes very important, and really it's a level where option plays are going to be indicated, and I'll be tweeting those. I haven't really changed anything here because 26.77 is still the most important level. We break that, we close above there. I have no doubt that we reach 27.25 within a couple of sessions. Really, it should be a very quick move. I still don't like NQ relative to SPY because it looks like too much risk for too little reward. And VX, as I've been saying, it's really not that bullish. That very important level I put in 1650, but a close below 1608 in cash to me is going to be a real indication that something very interesting is about to happen to the upside of equities. European equities, if I'm right, and the US dollar actually now starts giving way, are not going to be attractive compared to S&Ps. It will be a very strong headwind for them. And here what I have done is I've changed the level of the US dollar now 95.07 because it's below the 200-day moving average, and it's such an important level that if we start closing below there, I think we definitely go to 93.63, and at 95.07 I think you definitely want to have option plays shifted up here to 95.07 rather than 93.63, and I'll be tweeting those to you next week. I will actually put it in red because I think it is that important. As I've said before, when the market does something so unexpected and not justified by the movement, relative movement in the spreads, you have to sit up and take notice and think that something big is happening. Thank you very much indeed, and tweet you on Monday.